Hello and welcome to the latest instalment of WAM Vault. My name's James Marley and I'm your host, and today I'm joined by Matt Haupt and John Ayoub, who are portfolio managers of WAM Leaders. Matt and John, great to see you both again.
Yeah, likewise.
WAM Leaders is coming up on a 5-year anniversary, which is a really nice milestone, and even nicer when it's being marked with periods of strong performance. One of the marks of WAM Leaders is you guys have been able to successfully pick inflection points in the market. I'm keen to know, what do you think is the big inflection point that sits ahead of us now?
Yeah, James, I think the two real big ones this year are around China credit. Obviously last year they went incredibly hard trying to get the economy going during COVID. That was 12 months of intense credit origination, infrastructure, everything was firing on the policy front to get them going. We think this year that will decline. We're starting to see early signs of it declining now. So the last few months have been soft. But our big call this year is the credit impulse in China slowing and affecting commodity prices. Obviously commodity prices, everyone's really bullish on them at the moment. We're a bit more cautious on those bulks, so iron ore in particular. I think that's a real big inflection point this year. The other one would be around tapering. So last year was fiscal and monetary policy being incredibly easy, like the best it's been in history. It's really a historical moment. Everything was fired at the economies to try and get them going and get asset prices high. That will come to an end this year. And what I mean there is policy will be withdrawn. So it will be very easy withdrawal at first, but eventually that will accelerate. And already the market has got interest rate hikes priced in with a terminal rate. What we're looking for now is any change in the pace of the hikes and a change in the terminal rate as a key determinant of how we'll position the portfolio.
John, if we take ourselves back 12 months, the big call was the reopening and the economic recovery. What are some of the opportunities that you see right now?
Yeah, look, if we take a step back, we've seen a two-paced recovery, and much of the domestic markets and domestic facing economies have recovered, particularly in Australia. But we still haven't seen international borders open up. There's still elements of the market which still have some ways to go. If we put that perspective back on equity markets, valuations have become relatively full on a lot of names, but we still see pockets where the recovery still hasn't been fully played out. So sectors like healthcare, with particular CSL, you haven't seen the volumes of collections recover, and we still think next year you'll start seeing that starting to advance. Qantas, you still haven't seen international travel and corporate travel has fully returned. So from that perspective, we still see there are pockets, but valuations are starting to get towards the upper end. So for us, we're starting to become more and more selective around those opportunities, and there's fewer and fewer of them.
One of the topics you didn't touch on, Matt, when you talked about inflection points, was inflation. Now, inflation is the grand debate that's taking place for many investors at the moment. What's your view on inflation, and what does a rising inflationary environment mean for equity investors?
Yeah, it's the question everyone's asking at the moment. Inflation, is it transitory? Is it structural? I think the key point is you actually don't have to get it right in the medium term. Like we are going to have higher inflation. We've seen that coming through already, merely from base effects. So you will get higher inflation. So that will feed this trade. The medium and long term, we actually don't know whether this will be. Like our view is there is a lot of deflationary effects in force. It's thought large monetary increase will cause deflation over time. It used to be it would cause inflation, but studies have shown that it's actually deflationary over time. So that argument, I think we can park that medium to long term and just focus on that short term to medium term, and we will get higher inflation. So you've got to position your portfolio according to that. So when we look at that, we look at where do you park your money in a high inflationary environment? Normally it's around hard assets, so like commodities, which goes against the credit cycle, but the base metal or commodities will actually get some attraction and flow into those.
If we add to that, what we've seen in the inflationary environment is we're starting to see the early stages of cost pressure coming through from all scopes of business. For the last 5 years, we've been characterised by cost outs, and most companies have been talking about cost outs and cost outs. We're going to be seeing the opposite story over the next 2 to 3 years. So what we really need to see is that top line growth coming through. So if you kind of look around the world, supply chains are bottled up still, and you're starting to see lumber price accelerate up. So we've got to work out how long this lasts, when wage pressure starts to creep through. We're starting to see that already, particularly in WA around miners and cost pressures there from a wage perspective and a talent basis. So again, we've got to watch this really carefully and see how long it lasts, because as borders open up, we should start to see migrant workers return to Australia, should alleviate some of those cost pressures. But from that standpoint, we really need to see the top line of corporate Australia start to accelerate now.
Yeah, that's an important point too around output gaps, because economies are still under their potential GDPs. So as that output gap closes, that should be inflationary. So that's why we're quite confident in the short term that you play the inflation, you play the higher interest rate environment, and there are things you can really sort of put your money towards working in the short term.
And the last thing is that what we're most excited about is that we're starting to return back to normal markets again. Where thematic investing and just the lower rates forever and people just buy sectors rather than stocks. I think we're getting towards the end of that, and from that standpoint, we're really excited about the opportunities that we get from a stock selection basis as opposed to just pure thematic investing.
You gave us an inkling to a disagreement that you have with a common view that we're in a commodities super cycle at the start of one. Tell me about that view.
Well, I guess when you look at previous commodity super cycles, it was really a demand driven event where you had like the urbanisation of China for about 20 years. I mean, that was an incredibly driving force of the commodity cycle. And China, like we touched on there, have mini cycles, like boom and bust cycles based on credit. We're on the downturn of that one at the moment. So I think the supply side problems at the moment are driving this thematic around the super cycle, and also the inflationary pressures of money printing. That is the common thesis of the super cycle. I think that's wrong. I think that supply side will get sorted out. It's a restocking event. Economies were closed for 12 months. Everyone ran down the inventories. Now people are scrambling to get the inventories back and manufacturing back, building that base. So that is a driver. We're not in a commodity super cycle, unless there was another country which could pick up the slack from China, because they are the gorilla in the room, accounting for over 50% of copper, 70% of iron ore. I mean, they are the driving force of commodity prices in the short term. So I don't think we are.
And just to add on that supply side, and we go back to closed borders, labour is really tight. And if you look at how COVID's affected countries like Chile and Peru, it's really affected the supply output. And also Brazil. So from that standpoint, as that starts to normalise, we should see some equilibrium returning to commodity markets broadly.
Matt, let's switch from one dominant sector in the top 100 to another dominant sector, which is banks and financials more broadly. The banks have had a great run up, and we've talked about it in previous WAM Vault instalments. What's your view on the banks here, and how are you playing that financial sector?
So we're still very positive on the banks. The trade last year was quite obvious, trading at discount to books. Now the trade is a little less obvious based on the share prices. So the story around Australian banks is still around capital management. We actually haven't seen them enact capital management, and we will see them over the next 3 to 6 months really start to give back some of that excess capital. So CBA will probably launch an off-market buyback with a large franking component. National Australia Bank, I think, will do smaller bite-sized buybacks over the next few years. So the capital management story is real. That will come through. Also, the provisions which were raised during the COVID period obviously will come back as the Australian economy has performed quite well through various measures, through support and containing COVID. So there is still legs in the financial trade. It's probably done most of its work, but you can easily see another 10-15% upside from here. Or holding else equal in the environment at the moment.
Okay, banks are dominant players. Outside of the banks, what are some of the opportunities that you found?
Well, I still think, you're talking in the financial space?
Within financials.
Yeah, I guess the insurers are probably lagging where the Australian banks were. So what happened was the Australian banking sector raised provisions on the forecast of economic conditions being bad. Insurers got hit with the business interruption insurance claims, or potential claims, so they've raised provisions for that. It's just taking longer to unwind those business insurance, the BI. So we feel like the insurance sector is probably 6 to 9 months behind the Australian banking sector as far as trade goes. So there's still upside in the Australian insurance sector. It's just going to take a little bit longer to get paid for that. So I think that's a key area where there's still some upside.
Yeah, and a couple others potentially is Computershare and Challenger. So Challenger is something we reintroduced into the portfolio recently on the back of some a week update. But we think as the world normalises and rates start to head up and they start to get control some of their risk parameters internally, we think that could re-rate as well. So there are still pockets of opportunity starting to emerge in financials.
Well, we've talked about a few sectors and stock specifics there. Matt, I was wondering if you could wrap things up by giving us a bit of a synopsis on your view of the outlook for the Australian economy and some of the key things that are catching your eye, domestically.
Yeah, I guess with the Australian economy, there's obviously a disconnect with the share market, which is always the case. The share market is always forward-looking. So if we look at the Australian economy, we'd say we're coming out of a recession. We're early cycle. The stock market, I'd say, is late cycle, because when you move policy rates where they went to, you pull forward returns. So your future returns are limited now. So the economy is catching up towards the share market. It's just a debate about will the economic recovery be as fast or into the policy withdrawal. So it's a balancing act at the moment. And the way I look at the Australian economy is we'll be incredibly supportive until the Fed moves. So we're going to sit behind the Federal Reserve, the RBA. They won't move until they move. So we've probably got towards Q3 or Q4 before we get tightening in the Australian economy on the policy front. So I'm quite constructive on the Australian economy until we get that tightening. And that's just going to make it a bit more benign, the recovery. Because we're in this extraordinary period where policy rates couldn't be any easier. The RBA holding the 3-year rate down, it couldn't get any easier than this. So we are in the best conditions we could possibly be in, but the mismatch between the economy and the share market just says future returns for the share market are limited because policy will be going the other way.
And from that standpoint, we're strongly confident around active management and focusing on rotating that portfolio when we see opportunities. We think there's going to be significant dislocation towards the back end of this year. So from that standpoint, we're watching very carefully and ensuring that we position the portfolio and manage risk accordingly over the next 6 to 12 months.
Yeah, I guess to follow on as well, I think this period of excesses, which we're in at the moment, you see it everywhere. Different asset classes, crypto, all that will come out of the market as tapering happens because that's all predicated on ultra low rates and the death of fiat, which once we start tapering, we'll kill off that argument. So that excess in the market will come out as soon as tapering starts is our view.
So Matt, for investors and shareholders out there, how would you summarise the opportunity that exists in WAM Leaders from this point going forward?
Yeah, I think for WAM Leaders shareholders, there's two very big inflection points this year, and historically we've been very good at capturing those inflection points. So we have the two. We've got the China credit impulse rolling over, and we've got tapering happening this year. So they are very important events, and we're quite excited about the opportunities on these inflection points when they play out this year.
Well, Matt and John, thanks for your time today.
Thanks, James.
Thanks.